Oliver, Lex usually likes mergers which have oodles of cost savings. In fact, we don't like any other kind of merger. We have before us cost savings being offered in a merger of two British construction services companies, or as I like to call them, builders. Why don't we like the idea of Carillion chasing Balfour Beatty?
Well, you're right. There are lots of cost savings being offered here. Carillion says there could be £175 million worth of cost savings by combining the two. That's 16% of the cost base. That's very attractive if you want to create some value out of a deal. But you've got to look more widely at what the deal is. They bill this as a merger, but one of the other things we don't like on Lex is things being called a merger, and this is certainly not a merger of equals. This is, in effect, Carillion buying Balfour Beatty, and it will be a huge deal for Carillion. There are two things really not to like. The first is the scale. Balfour Beatty's revenues are about 2.5 times those of Carillion, so it will be an enormous chunk for Carillion to take on. And the other thing is that Balfour Beatty itself is in a bad way. It's had a very tough year, so Carillion will be buying a large, troubled company. Is it really worth that risk?
Tell me about why Balfour Beatty is in a bad way. I mean, we know, UK construction hasn't been great, but surely it should be jumping at the opportunity to sell itself, no?
Well, possibly, and it has had a bad year. The problem for Balfour Beatty has been its UK construction business, where Balfour likes to do big, exciting, high-profile, large-ticket contracts, but there's not many of them. During the recession, companies weren't building big new facilities, and the government pulled back its spending. So after the Olympics, there wasn't that much new exciting stuff to build. So Balfour, in order to keep its revenues going, went down market towards the smaller contracts, and it slipped up on a couple of those. It's had some problems, hence profit warnings, disappointing results, that kind of thing. So UK construction is where the problem has been. Now it's a late cycle business, construction and building, so it won't be starting to recover just yet. And as to why Balfour doesn't want to sell itself, well, it thinks that Carillion might cut back its UK construction business too much. It also thinks the deal might interrupt the sale of Parsons Brinkhoff, which is a US business that it's trying to sell.
Okay, now briefly, what should Carillion do then, other than bid for Balfour?
Well, I'm not bothered bidding for Balfour, I think, is the right thing to do. The cost savings on offer are very nice, but this is a huge risk. And Carillion's been a nice, well-managed business. If you look at the two share prices since the depths of the crisis, Carillion's up almost 80%, Balfour Beatty's only up 6%. So Carillion shareholders have got a nice, not very exciting, but nice, sensibly run business, focusing on high-margin construction, infrastructure investment and support services. There's quite a nice future there. It doesn't need to be chasing big, high-scale, high-profile deals with an awful lot of execution risk, so it should just pull out.
Okay, beware of construction projects. Thank you, Oliver.